Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to continue a conversation we had last episode talking about retirement readiness, right? Last episode, we talked about our theory of why we think retirement in oil and gas is going to accelerate and what that means for different people, depending on where they are in the retirement race. This week, we're going to talk about, hey, okay, how do I assess retirement readiness? Where am I at? Is a severance package is that thing that pushes me over the hurdle? Am I already good? Do I have a lot of work to do? Just really unpacking how do we go about that. So Justin, where do you want to start this conversation? And I think what are the big things to think about when you're assessing whether or not you're actually able to retire?
Yeah, Jared, maybe I'll do a super quick flyover of how we got here. So to repeat something from the last episode, you and I had a conversation 2.5 years ago. So this is Q1 2022. For those listening to this, you might remember 2022 is this strange year where the Fed just increased interest rates, to an unbelievable degree. And the result on super majors, if you work at a super major, was your pension value just cratered when interest rates dropped. As a result, an enormous amount of people who were going to retire in late 22, 23, or 24 all retired in Q1 or Q2 of 2022. So the way that nets out is a bunch of people retired, and we predicted that, hey, no one's going to retire from a super major for the next 2.5 years. And that was pretty spot on. So now we're at the end of that kind of trajectory. We're here in 2025 and people are starting to retire again. ExxonMobil actually had some interesting movements within their segment rates that determine the lump sum value of everyone's pension. And the Q1 rates are pretty attractive. They're better than Q4 of last year and they're better than Q2 coming up of this year. So we're seeing a lot of people retire. That has implications for super majors. It has implications if you're younger and you're at an oil and gas company thinking about your, career trajectory and moving up the ladder. And then this podcast, Jared, we're going to hone in on what if you're in that situation now and you are asking the question, can I retire? If you're at Chevron, are you asking the question, should I raise my hand and express interest in leaving the company and taking a severance package? So I think that's what we want to determine by the end of this podcast. If you are, age 55 to 65, and you're still at a super major wondering, should I go ahead and take a severance package, go ahead and retire? Here's how you want to answer that question.
Yeah. So what's the first question? Where should we start this conversation?
Most simple, elementary question. Do you have enough assets? Do you have enough assets to stop working or at least make work optional? Jared, I think something that's interesting is there is a little bit of finality when you leave a company. And if it's a company you've been at for decades, off the top of your head, Jared, how many of our clients have retired, but they're still doing consulting work?
I don't know a number, but if I had to guess a percentage, I would say 2/3 are doing some form of employment.
It's a ton. I am amazed at how many of our clients have either engaged in consulting work or they've been offered it to some degree. Now, that's a great thing. I hope it continues, right? I think the financial planning secret with retirement planning, if you can cash flow and really bridge the gap from age 55 to about 65 or 70, you're really bulletproof. You're providing a tremendous amount of security to your balance sheet. So consulting work that provides some amount of income is a tremendous way to do that. But Jared, I do think as CFPs, you kind of got to plan for the most difficult scenario, not the rosy scenario. Therefore, you really have to plan for, hey, if I'm going to raise my hand and retire, there will not be any consulting opportunities and I'm not going to work again. But to answer your question, number one, the starting point is asking, do you have enough assets? How do we get there?
So just kind of general boilerplate, right? Like if we're just going to do back of the envelope math, we did a whole podcast on this that we'll reference. We talked about Bill Bangan's 4% rule, right? And he created a piece of research that basically said, bunch of assumptions. If you have a 30-year retirement time horizon, 4% is what you could spend, right? So like if you were to do really easy math and say, if I need $40,000 a year, I need an $1 million portfolio. But just the problem with that is it's like a great like just estimate, but it's reality is like so much messier than that. Like what's the composition of your assets? You can withdraw 4%, but depending on the mix of your assets, a variable percentage of that is going to go to taxes, right? So, okay, how much does that mean you can actually eat of that 4%? The other thing, this retirement projection is 30 years, right? Life expectancy is creeping up. And depending on how early you retire, your time horizon could be longer or shorter than that, right? What are your issues with the 4% rule? I mean, I think it's a good like starting place, and we'll link to the podcast where we go to in a lot more detail. But I think it's an orienting thing where it gives you like, am I even in the ballpark? But I do think it's incomplete.
There's so many variables with the 4% rule. So Bill Bengen, who came up with the idea, he actually logged on to Reddit like 5 or 10 years ago and went way deeper and kind of did an Ask Me Anything session. And it was super fascinating. A few things stick out. One, Jared, is that was for a 30-year retirement. And, the end result there is that if you just take 4% a year in year one, and you have a diversified portfolio in quotation marks, there's never been a 30-year rolling period over the last century where you ran out of assets. So it was very secure. I think the other interesting thing was he emphasized that, hey, 4% is the year one withdrawal. So if you have $5 million, well, 4% means that your annual income is $200,000 is your annual income if you're taking 4% of 5 million. Now, Jared, that was year one. So Bengen, in all of his back tests, he is assuming that you give yourself an annual inflation pretty in line with inflation, an annual adjustment, annual increase that monitors wherever inflation is. And so he is back testing, assuming you give yourself about a 3% raise. So 200,000 year one is your income, 206,000 is your income in year two. And then if you fast forward, 22, 24 years, your annual income is about 400,000. So it's not a static number. That's why if you have a lot of assets, it's often not really in your best interest to pursue a fixed income annuity in retirement. It can absolutely be in your best interest in certain situations, but you often aren't getting those increases every year. Jared, there's also, as Bengen put it, there's the ability to take more than 4%. He actually back tested it, and he says his original work actually was secure at 4.5%. being your year one withdrawal. And so now you're taking even more than 200,000 in year one. Also, you can go above 4.5% if you are dynamically rebalancing and if you're willing to deviate slightly in those rebalancing efforts. So an example of that is, if the market crashes and you're in a 60-40 portfolio and stocks are now on sale, if you're willing to buy stocks at a discount and go to 70-30, that's very advantageous. That actually increases the amount you can take. Also, if you're willing to get dynamic with where you're taking income from in the portfolio, that also allows you to take more. So market crashes and you have a 60-40, 60% stock, 40% bond portfolio. Well, wait to take anything from stocks for a few years. Take everything from bonds, which will naturally mean that your 60-40 could turn into a 70-30 pretty quickly. Tax loss harvesting, Roth conversions, tax planning in general, also a way to help you take more than 4% per year. Jared, one other thing that we talk about on this podcast a lot. How do most financial advisors charge?
AUM, assets under management.
Yes, typical fee, 1%. You hand an advisor $5 million, $10 million. They're going to charge you $50,000 a year. As the assets get bigger, it might get a break point, but it's going to be pretty close to 1% every single year. Bengen actually looked at this and determined that you can go above 4% if you're in a more advantageous fee structure. And so we love being fixed fee because it puts you in a little bit safer of a position because you're not paying 1% out of your account every year, assuming that you have a larger portfolio. So I think that's a good kind of overview of the 4% rule. So I think the big question is, do you have enough assets? And Jared, you got to go to how much do you spend? So if you know that 200,000 a year can pay your tax bill, it can pay your health insurance, it can pay all of your random one-time expenses throughout the year, as well as your fixed monthly expenses, as well as any, travel, gifting that you're going to do, helping out family. If it can do all of those things, well, that's a pretty good sign. What else should we cover there?
Yeah, I mean, here's the problem, right? Like nobody spends 4% inflation adjusted throughout retirement indefinitely, right? Kitces has some good research that we'll link to that talks about there's like the retirement spending smile, right? Where like expenses are highest post retirement because like there's a lot of excitement related to being retired. There's a lot of mobility in terms of, hey, I can do all these trips, I can do all the things on my bucket list. Kids being in an age where like, they might need support in a busy season with home down payments, college, marriage, all of those things, then, kind of slows down as you physically slow down. And then of course, end of life care is costly. So expenses pick back up, right? So this idea of just this 4% inflation adjusted, it's more of a marker than a rule, right? And nobody's lived experience is going to be 4% directly from their portfolio assets because Social Security, at some point, even if you delay it, there's a big range of when you can take it in the net present value, depending on when you take it. But Social Security is going to factor into that equation. So, by saying, hey, I can only take 4%, it might be a conservative starting point. But if Social Security replaces 40% of your income a decade from now, that might change the math of what you might be able to spend. So I think just saying, hey, 4% works, it's overly simplistic, but I do think it's a good starting point. We have software that kind of helps people map this out, but because of all of the moving variables, I think you kind of have to do some version of mapping this out of, hey, what do I think I'm going to spend? And that's the other problem is you're making a presumption about, hey, what's going to happen 20 plus years from now? What am I going to spend? What is my life going to be like? And we're not very good at predicting that. And so, it's a helpful starting point, but there's just so many things to be considered. I think, one of the big things is if you think about, hey, Social Security is coming into the mix, there's almost like a pre-Social Security and like a post-Social Security in terms of like what the strategy is and maybe what even the withdrawal rate is.
Jared, absolutely. The textbook term for this discussion, we are trying to figure out what is a sustainable withdrawal rate. I find it super interesting that I would actually make a really strong argument, Jared, that every person has to understand sustainable withdrawal rate and make sure that their assets are kind of in bounds in terms of having one. And what I mean there is, hey, if you have $2 million and you're going to stop work, you have to figure out, obviously, I mean, that's like textbook CFP stuff. Hey, how much can I withdraw from my portfolio every year? But I mean, that's for 2 million. Jared, if you have 200 million, you still need to figure out which part of my portfolio is going to be invested with the purpose of paying annual operating expenses and what's the sustainable withdrawal rate from that bucket. So everyone has to answer that question. And you just hinted at something. Here's the tricky part. Jared, a sustainable withdrawal rate in the CFP textbooks is often described as kind of a one-time calculation, and then it stays there. But I mean, this is even more true in oil and gas than other professions. If you are retiring at 54, at 58, Jared, it's not a one-time calculation and then let it run from there. You're essentially solving for kind of one retirement, and that is age 58 to whenever you take Social Security, which is hopefully age 70, right? And then you're solving for, okay, then what does retirement income look like after I reach that point? So you kind of need to draw a line on a timeline and kind of draw a space that, hey, this is retirement one. I've got to figure out how much can I withdraw for this 8-year period, 12-year period until you take Social Security. And then number two is, okay, what about every year thereafter, from 70 to age 98? And so it's got to be a much more manual, dynamic calculation to figure out okay, how much am I going to take now and how much am I going to take later?
Yeah. And that's the thing is like sustainable withdrawal, right? Like Bangen's research said, what could you take out? But what you're going to take out is going to be different depending on kind of the seasonality of your portfolio. But I mean, so Justin, before we go any further, you talked about something really important. It's like, okay, do you have enough assets? How do you know if you have enough assets? Okay, 4% is like a good ballpark to be like, am I in the vicinity? But you need to compare that to your spending, right? You need to have like a good idea of your spending. It's not even a complete place, but like having an idea of, okay, what do I spend is really helpful to say, what does the 4% number look like? And then what does my annual spending look like? And the easiest way to do that, if you don't want to keep a budget, is just to reverse budget and say, okay, how much did I save in the last 12 months? You can't count your mortgage and 1 month of credit card bills and call it a budget, right? Because there's travel, there's one-time expenses, there's improvements to your home, there's helping a family member. Like life happens. So like the easiest way to find out, okay, what am I actually spending is, okay, what am I saving every year? Because if you tell me, hey, my expenses are 16,000 a month and you make a nice income, let's say you make $20,000 a month and you say, hey, I spend $15,000. So hypothetically, there should be 60K, and we'll assume all this is after tax, right? Yeah, there should be 60K extra. So your cash balances are growing or you're funding a brokerage account. If at the end of the year, you don't have any excess cash flow, you're spending 20, you're not spending
You're
15,
not spending 15.
right? And
But it's
so
such an important example.
so I think, auditing and like there might even be life seasonality to this, right? What you spend in there are more expensive and less expensive years. So it's like you really need to kind of see over, hey, the past few years, what has my saving been? Because that is really telling about, okay, what do I actually need for living expenses? Because that's the number that needs to be compared to, hey, what can a portfolio produce? How much difference is there?
Jared, I also just think, you mentioned something with the smiley face or whatever as it pertains to lifetime expenses. You typically spend more in your first 10 years of retirement, and then you slow down a little bit, and then you spend more at the end of life, potentially for healthcare. But Jared, I mean, you also need to be really specific and kind of determine, hey, what's my withdrawal rate for the first 10 years before Social Security and then after? Because if you have a lot more assets than you probably need, well, then you probably want to be strategic with that, right? And you probably, want to know and have a plan around, hey, I could take 5%, 6% for this, short window, because at the end of the day, you're going to be able to do some things at age 61 that you may not be able to do later in life. And so you don't want to have a much lower withdrawal rate than you need. And then, you kind of regret, hey, I could have played a bigger role in some things that my kids were doing. We could have gone on these trips, had these experiences. So it is important to get pretty dialed in with different withdrawal rates at different phases of retirement.
Yeah. And that's the thing. Like you need to say, hey, what are my annual expenses? And then, okay, what could my portfolio produce at 4% is a good kind of starting place. But then you have to do the analysis. So, okay, what do I think my expenses are going to be in 10, 20, and 30 years? And of course, we're terrible at this. Like we have no idea. You've never been those ages before. You have no idea how your life's going to shake out, but just begin to get a ballpark of, okay, kids will be off the payroll. Okay, I have medical insurance through my employment, so I won't have that big expense. But it will be increased slightly because of deductibles and stuff like that. Okay, and then what do I want to do from a travel perspective or assistance to the kids? And then how do I anticipate those things change as I get a little older, right? So just begin to kind of map out, hey, what do your expenses look like now and in the future, right? And you're talking about something important of like, hey, how do we kind of acknowledge the seasonality? Because I think like life is full of seasons. So to just say, hey, here's my expenses at this time, those aren't going to be your expenses indefinitely. And if you're retiring and have kids in college age kids, they're probably still on payroll, right? So like just trying to normalize and see, hey, what do I think is going to happen to my expenses over time as I reach these different seasons and milestones?
And, I want to repeat something. You need to be really honest when you budget. And I don't think you need to budget at every point in your life. But if you're asking the question, should I express interest and stop working now? You've got to think about it as annual budget, not monthly budget. cannot emphasize enough how right you are in your example, Jared. There are a lot of people that will put together, okay, here's what I'm spending every month. I'm going to write everything down. And let's say it's $15,000 a year, but their actual take home pay from their current job is like 22,000 a month. It's not 15,000 a month. And then at the end of the year, there's almost nothing left over. And so you really have to be honest. You really have to figure that out. Because if you think you're spending 15 and you're actually spending 21, that's a really big problem when it comes to sustainable withdrawal rate.
Yeah, that's exactly right. Okay, so you know your expenses, okay, what does your asset base look like? But also, right, like what is your tax strategy, right? Because if you think about oil and gas professionals, like we talk about, you generally, because of the pension and the matching in their 401k, pre-tax is a high percentage of their investment allocation. So if you think about your balance sheet, if most of it's in pre-tax, there's a big question mark in terms of what is the after-tax value of this portfolio. And it's a function of how do you manage the timing of cash flows? How do you strategically deplete the various different types of accounts? So in terms of, okay, what do you actually have available to fund your lifestyle? Some of that pre-tax account is already spoken for, but how much that account is spoken for taxes is a function of a tax strategy. So what should people kind of think of related to that when they're thinking about assessing their retirement readiness?
Absolutely. Jared, we've mentioned this before, but the unique thing about super majors and majors as well, however you want to label it, just big oil and gas companies, their benefit structure is so much different than the typical American company. So average 401k match, and actually, let's expand that definition, Jared. The average company contribution to any retirement plan, on average, there is no pension. It's just 401k, and it's usually about 3 to 4%. It's kind of the average or the median across really every industry, across big companies. Now, the difference with oil and gas is, you're going to have a company that's putting 7% into the pension. They might be putting a 7 to 10% match in the 401k, and there might be an additional profit sharing or experience matching company contribution component that is another 5 to 10%. And so at the end of the day, between 401k, between pensions, it's not uncommon for the company, not just you, but the company to be putting in 15 to 25%. We have a few folks at Western Midstream collecting a 25% match just in their 401k, which is just unbelievable. And so the result of that is when it comes to tax planning, well, across every industry, you kind of delineate there's two types of people in a typical company. There's people that have really significant assets and income, and then there's more of the middle class, everyone else. And tax planning in most companies is really only relevant if you're making an enormous amount of money or you have a lot of assets, 8 figures, 9 figures plus. Now, in oil and gas, as we've kind of hammered on, you don't have to be an executive C-suite person to make a few $100,000 a year and then wake up at age 60 with 5 million in retirement assets. And so you have an enormous amount of tax opportunity starting when you stop work through the rest of your life and beyond. And so I think step one, you need to think about your balance sheet in very different buckets. Investment wise, you need to think about your balance sheet in terms of, hey, what is ultra short term? It's paying bills on a monthly basis. Obviously, that needs to be cash. Hopefully, you're capturing a high yield. And then what about the next bucket? How do I navigate my next 5 years of living expenses? And then how do I navigate kind of years 6 through 35 plus? Those need to be invested very differently. Duration matching, you need to invest based on your time frame with each bucket of money. But then tax-wise, you must delineate between pre-tax, Roth, and non-retirement. And hopefully the investment and tax buckets can kind of work side by side. What else should we cover there, Jared?
I think duration matching is like such an important idea, giving every bucket a job, right? And thinking about the various pros and cons of each type of tax registration. What we mean by that is like pre-tax accounts, retirement accounts, Roth accounts, and then brokerage accounts. understanding, hey, what assets am I going to put in here and what assets am I going to pull out and when, I think is also really, really important, right? And kind of understanding the seasonality of, okay, if I'm pulling out of this bucket and my distribution rate is higher than 4 or 5% in the first few years because you've figured out that you can because of Social Security coming down the pike, your portfolio is going to look different than it will once Social Security is in the mix, right? And the pressure on the portfolio to produce income is slightly reduced. But I think that's, this golden window pre Social Securities and RMDs is important, right? And we talk about it all the time because there's so much more flexibility in when you realize income. Once you turn 70, Social Security happens, which is great, but it's a certain amount of income every year. RMDs, required minimum distributions from IRA accounts and 401ks, those are required, right? So fixed. So your flexibility and ability to strategically kind of just partition out where am I going to pull income from and when and what are the consequences of that, I would say there's an outsized benefit pre-RMD ages. So just summarizing, and then I'll go back to you to see if you have anything else. But so how ready are you? It's simple questions. But I think there's just infinite number of complexities of implementation. So am I ready? It's okay, do you have enough assets?
Yep.
Okay. Do you have a good idea of your expenses both now and in the future?
Yep.
And then what's your plan for distributing, translating your asset base into a paycheck? And what does that mean your estimated after-tax assets are, right? Because if you have mostly pre-tax assets and one client ineffectively distributes and ends up paying an average effective tax rate of 30%, and somebody else, conversely has a more strategic income plan and pays an effective tax rate of 15%, person B, assuming all else equal from expenses, investment allocation, is going to have substantially a higher odds of success, not because they spent less, but just because they were more strategic about their income plan. So I would say those are really the three things. And I would say they're simple, but they're not easy in terms of thinking about, are you ready to retire? What would you add?
Yeah, I think that's it. Do you have enough assets? Do you understand what your expenses now and in the future are? Do you have a plan for a dynamic, sustainable withdrawal rate? And then what's your tax strategy? And so again, to reiterate, everyone knows that, hey, if you have $20 million, there's a lot of tax things that you need to consider, that you need to be aware of. But the unique aspect of oil and gas benefits is if you get to retirement and you have 7 figures and not anywhere close to 8 figures, you have enormous tax planning to do. If someone heads into retirement with 4 or 5 million in a pre-tax IRA, Jared, depending on their other assets in their balance sheet, they could easily be looking at lifetime tax opportunity of more than $1 million by properly navigating capital gains rates as well as Roth conversions in the coming years. And so you have to have a pulse. And I think that's the summary of this entire podcast. Do you have enough assets? What are your expenses? How are you going to turn your assets into income? And then do you have a really detailed tax plan for the next 30 years? And those are the questions you need to be able to answer if you're figuring out, should I retire right now?
Yeah. And it's a big puzzle, right? That's the thing is retirement readiness is an ongoing thing. And figuring out it's not an event. Okay, I'm ready. I'm just gonna implement the plan and not touch anything ever again. Right. Investment returns change. Tax law changes. Right. So that's the thing that's kind of liberating. You probably hear this and you think, man, I got to have all the answers before I retire. Having all the answers before you retire is an impossible thing because you just don't know how things are going to unfold. But this muscle of assessing retirement readiness and thinking through all these things, both pre and post-retirement is a good thing. And I think it's going to increase your odds of success.
Absolutely. Well put.
Awesome. Well, I think that's a great place to wrap up. Always love hearing from our listeners. Podcast at brownleewealthmanagement.com. Thanks. We'll see you next time.